Good evening to all the participants. It's indeed a great pleasure for me to conduct today's webinar on how to determine the real valuation and intrinsic valuation of shares. Now, friends, before we start, I given a choice, I would always love to make these programs interactive. But now that we are in a virtual mode, that interaction may not be possible. But at the same time, I would definitely like to answer all your questions. So what you can do uh, during the course of the presentation, if you have any question or query or any doubt on whatever that we are discussing, you can write your query in the chat box. And towards the end of the session, we will take all your queries and answer them one by one. So welcome once again. How to determine the real valuation and intrinsic valuation of shares or value of shares. Now, friends, all of us are aware of the fact that in the corporate world, so many decisions are taken for the growth of the organization. That growth comes in the form of organic growth, and it also comes in the form of inorganic growth. And doesn't really matter whether it is coming in the form of organic growth or inorganic growth. In both these situations, the corporates have to take a decision. And one very important tool which is available in the hands of the corporates for the purpose of decision making is the valuation. I'm sure all of you can very easily imagine it is just not possible for any corporate anywhere in the world to take any business decision without really finding out the valuation. And that is why we have this webinar today on this very important aspect of valuation. I intend to make this webinar very simple and very easy to understand all the aspects of valuation. So we start with the first thing, and that is what is value? And I'm sure when I ask you this question, what is value? A lot of answers must be coming in your mind. And let me tell you the simple definition of value, and that is utility of an asset is value. What is value? Value is nothing but utility of an asset. An asset which has a utility has a value. An asset which does not have a utility, it is not, if it is not, it does not have any value. And which means what? Which means in simple words, if I can tell you, जिस एसेट की कोई यूटिलिटी नहीं, उस एसेट की कोई वैल्यू नहीं. So this is the first thing that we need to bear in our mind, that valuation is directly linked with the utility of an asset. जिस एसेट की जितनी ज्यादा यूटिलिटी होगी, उस एसेट का उतना ज्यादा वैल्यूएशन होगा. This basic understanding, I think all of us must always keep in our mind whenever we have to involve ourselves in any corporate decision making process. Then what is valuation? Again, valuation is very simple. Valuation is nothing but quantification of utility of an asset in terms of money is valuation. So what is valuation? Valuation is nothing but quantification of an asset, quantification of utility of an asset in terms of money is valuation. Now the question is, why do we do valuation? And we do valuation for the simple reason because somebody has to take a decision. So the prime objective of any valuation done anywhere in the world is decision making. Remember, unless and until someone has a decision to take, he or she will not go for any valuation. He or she or any corporate for that matter will not go for a valuation. A promoter will go for a valuation if he is intending to sell his company, if he is intending to divest his shares from the company, or he will do the valuation of another entity when he is trying to purchase that entity. So ultimately, what is in the foundation of any valuation exercise is the decision making. Now, the fourth question that we need to answer is what do we find through valuation? तो हम valuation के through हम मालूम क्या करते हैं? And let me tell you, friends, once again, the answer, of course, is very simple. Through the process of valuation, what we try and find out is nothing but fair value of that asset or that liability. So when we are doing valuation of any asset, it can be a tangible asset, it can be an intangible asset, it can be a physical asset, it can be a financial asset, it can be derivatives. It doesn't really matter. It can be land and building, it can be plant and machinery. So whenever we are doing valuation, what are we trying to find out? We are not indulging in simple mathematical exercise. We are trying to find out as to what is the fair value of that asset, what is the fair value of that liability, so that a decision can be taken based on that fair value. Now, what is fair value? And fair value again, friends, very simple. Fair value is a value which is arrived at for exchange of an asset or of a liability between two parties when the parties are completely unrelated and the transaction is being done at the arm's length. और arm's length का मतलब क्या है? Arm's length का मतलब ये है कि other than the exchange of the asset and the consideration, nothing else is involved. Further, fair value का यही मतलब है both the parties, the buyer and the seller, are willing to enter into the transaction, and neither of the party, that is buyer or the seller, is under any kind of force, coercion, or any other pressure onto them for arriving at that for entering into that transaction. And that is what is fair value. Now the question is how to do the valuation. And friends, that is what is the focal point of our webinar today. So how to do the valuation? Now, friends, please remember there are many approaches for the purpose of arriving at the value of an asset, and there under those approaches there are many methods of arriving the value of those assets. Now, what we will do? Now we will discuss as to what those approaches are for the purpose of valuation, and under those approaches, what are the methods for the purpose of valuation. So primarily, please remember, whether you do valuation in India or in America or in Europe or in Australia or in any part of the world, please remember, basically, fundamentally, there are only three approaches for the purpose of valuation. Now, what those three approaches are for the purpose of valuation? Approach number one is known as income approach. In approach number two is known as market approach. And approach number three is known as asset approach or the cost approach. Now, a question must be coming in your mind as to why income approach is called as income approach, why market approach is called as a market approach, or why the cost approach is referred as cost approach. And let me tell you, friends, the answer again is very simple. What is the answer? The answer is when the basis for valuation, the information that you are using for the purpose of arriving at the value, is related with the income of the business or income of the asset, that is known as income approach. Likewise, when for the purpose of doing valuation, the information that you are using is linked with the market, and that is known as marketing approach. And the cost or the asset approach, when information that you're using for the purpose of valuation is linked with the asset or the cost of that asset, that is known as cost approach. And I'm sure, friends, this understanding will again remove lots of doubts in your mind, and you would be able to very easily understand as to why there are only three approaches for the purpose of valuation. Because the valuation can be done only based on the information relating to the income of the asset, or the market information, or the asset information. Now, under the income approach, primarily there are two methods. The first method is known as income capitalization method. Income capitalization method. This income capitalization method is also known as PECV method. PECV method का मतलब क्या है? PECV का मतलब है Profit Earning Capacity Based Valuation, or it is also known as past earning capacity based valuation. यानी कि under the income approach, you do the valuation of a business based on the income this business has generated in the past. And since you are using income, and that is what is known as income approach method, income capitalization method. The second method under the income approach is the discounted cash flow method. And, uh, and this is the focal point for our discussion today, discounted cash flow method. I'm going to discuss a lot more about it as we move forward. Under the income approach, there are two methods primarily. Number one is, or rather, three methods primarily. Number one is the quoted price method. Under the market approach, the first one is known as quoted price. Now, what does it mean? It means a company that you're trying to value is listed on a stock exchange. So the market price of this company, which is quoted on the stock exchange, that becomes the basis for the purpose of valuation. So that is the first method, using the quoted price. The second is comparable company. Meaning what? Meaning it is not that all the companies on this earth are listed on the stock exchanges. There are companies which are private limited company. There are companies which are public limited company, but they are not listed on a stock exchange. And it does not mean that there are no transactions of transfer or purchase or acquisition or takeover in case of a private limited company, or in case of a listed, unlisted public company. There are transactions. So if there are transactions of purchase or takeover or acquisition regarding a private limited company or unlisted public company, then how do you do the evaluation? Because they are not quoted. So that's where you use the comparable company method. And that means what? That means the company that you're trying to value may not be listed on the stock exchange. But what you can do, you can try and find out if there is another a company which is of similar type as the company that you're trying to value, but that company is listed on the stock market. So you try and pick up the price, quoted price of that company, adjust it for certain differences between the target company and the listed company, and you try and moderate and find out the value using the quoted price of other company. And that is what is known as comparable company method. Under the market approach, the third method is comparable transaction method. And as you can very easily understand, comparable transaction. That means what? That means the company that you are trying to value, or the asset that you're trying to value, if there has been any recent transaction in that kind of a company or in that kind of an asset, you try and find out at what value the recent transaction has been done. And the value of a recent transaction becomes the basis for doing the valuation of the company that you have in your mind. And that is how it is known as comparable transaction method. Now, under the cost or the asset approach, there are four methods. So the first method under the cost or the asset approach is known as book value method. And I'm sure you can very easily understand book value method का मतलब क्या है. Book value method का मतलब है you pick up the balance sheet of the company that you want to value, take the figure of all the assets minus the figure of all the liabilities other than the equity or the shareholders fund. What remains in your hand is the book value method. So book value method is exactly as per the balance sheet of that company that you are trying to value. And that is how it is known as book value method. So the value based given in the books, that becomes the basis, and that is how it is known as book value method. The second method under the cost and the asset approach is known as adjusted book value method. Now, what is the meaning of adjusted book value method? The meaning of adjusted book value method is you don't pick up the figure as they are given in the balance sheet. You make certain adjustments to those figures. Say, for example, the company that you are trying to value, it had purchased a land 25 years ago at a cost of 1 crore rupees. Today, value of that land is 20 crore of rupees. So if you go and sell it in the market, you will get 20 crores from the sale of this land. So now when you are trying to do the valuation using the balance sheet figure, in your computation, you don't take the value of 1 crore for this land. What you take the value, which is 25 crore. So you adjust the book figures so as to arrive the real value of that asset or of that company. And that is how it is known as adjusted book value method. Another example, this company is also having investment in shares of another company. And the figure of investment of all those shares in which this company has made investment is, let's say, reflecting in the balance sheet as 2 crore. Now, you don't take it at 2 crore. What you do, you find out as to जो share इस company ने purchase किए हुए हैं, the shares which this company is holding, you try and find out as to what is the current market value of these companies and take that figure and adjust the book value figure accordingly. So this is another example of the adjusted book value method. The third method is replacement method. That is as is what is. So replacement का मतलब वैल्यूएशन का मतलब ये नहीं है कि आप एक जो मशीन को आप वैल्यू करना चाह रहे हैं उस मशीन को रिप्लेस करेंगे तो कितनी कॉस्ट पड़ेगी एंड दैट इज द वैल्यू of this as machine that you're trying to value. No, replacement method means the asset that you're trying to replace, what is its current condition. So what should be the value of an asset which is of exactly of same type as the asset that you're trying to value. So that means you will make the adjustment for the depreciation and other things in that balance, depreciation and other reduction in the value of that asset, which can be on account of many things, that also you will take into account. And the fourth method that you have under the asset approach is known as liquidation value method. So what is the meaning of liquidation value method? The meaning of liquidation value method is that this company that you're trying to value, let's say, has gone in for NCLT. It has gone under Insolvency and Bankruptcy Code 2016, and somebody has filed the petition under section 7, 9, or 10 of the Insolvency Code, and the order has been passed by the NCLT for CIRP. CIRP also has failed, let's say, for example, and therefore now this company is going for liquidation. So now a liquidation method would mean that if all these assets are sold today, how much will be the realization? And from that realization, first you minus the amount of expenses that you would have incurred in selling those assets and realizing the money. And then you also minus all the liabilities. If anything remains in your hand after that, that becomes the value of an asset based or the company based on the liquidation value method. Now, friends, when we are discussing valuation, it is very important for every one of us to also be aware of something which is known as IndAS 113. IndAS 113 is about fair value measurement, or IndAS 113 is on fair value measurement. Now, IndAS 113. So please remember, as a valuation professional, whenever you're doing the valuation, you have to ensure that you are fully in compliance with the provisions of IndAS 113 which is on fair value measurement. Now, this IndAS 113 gives three labels of, it gives a hierarchy of three levels for the purpose of valuation. Meaning what? Meaning it, it says that when you have to do value an asset, you must follow an hierarchy. And what that hierarchy is, that hierarchy of the information that you would use for the purpose of valuation, that hierarchy would say, number one, label input one. So what IndAS 113 says, that when you are doing valuation of an asset, first information that you must use, which is label one input. And what is label one input? Label one input is the quoted price of that company. So that means, as per IndAS 113 also, if you have to do valuation of an asset which is listed on a stock exchange, then you must first take into account label one input, and that is the quoted price. As we were discussing, it is possible that every time a company may not be listed on a stock exchange, or an asset may not be listed on an exchange. Now, in that case, what you do, the IndAS 113 says, in that case, you use the label 2 input. And what is label 2 input? As we discussed little while ago, label 2 input is you use the other observable market information. You use the other observable market information. Meaning what? If company is not quoted, as we discussed little while ago, remember that is again in line with the IndAS 113. So if the company is not listed, how do you do the evaluation? You do the evaluation based on the observable input. That means market information. So you can follow the comparable company method, or you can follow the comparable transaction method. This IndAS 113 also talks in terms of level 3 input. Meaning what? Meaning you you have been appointed as the valuation professional by by an owner, by owners of a private limited company. तो एक प्राइवेट लिमिटेड कंपनी है, और वो प्राइवेट लिमिटेड कंपनी 500 करोड़ का टर्नओवर है, 100 करोड़ का प्रॉफिट आफ्टर टैक्स है, और वो जो ओनर हैं वो प्राइवेट कंपनी के, अब ये इस कंपनी को सेल करना चाहते हैं ना, ये कंपनी को सेल करना चाहते हैं। तो अब सवाल ये पैदा होता है, हाउ डू यू डू द इवैल्यूएशन? बिकॉज लेवल वन इनपुट इज नॉट अवेलेबल. व्हाई? बिकॉज दिस कंपनी इज नॉट लिस्टेड. Level 2 input is also not available because it's a private limited company. And being a private limited company, it is very difficult to find out a comparable company which is comparable in all respects, so as the same company. So then how do you do the evaluation? And that is where the IndAS 113 talks in terms of level 3 input. And what is level 3 input? Level 3 input means that if the company is not listed, there are no observable information about that company. So then what you do, you create information about that company for the purpose of valuation. And by using that information that you create for the purpose of valuation, you do the evaluation. And that is what is your level 3 input. So incidentally, level 3 input would mean you are talking in terms of discounted cash flow method. And why is that so? And that is because when you are using the discounted cash flow method, remember what you are doing? You are using the cash flow of the company. So how do you do the cash flow of the company? Projected cash flow of the company. You do the projections of company's business for next 5-10 years, and you use that projected cash flow for the purpose of doing the valuation of this company. Friends, for your information, I would also like to share with you that income approach, and under the income approach also, the discounted cash flow method is the most fundamental, dependable, and reliable method for doing the valuation of any entity. Only precaution that you have to take, that when you are doing the projected cash flow, make sure that you are absolutely realistic in making the projected cash flow of that business. And number two, you also need to determine the cost of capital. And again, you have to be very, very clear and precise and as accurate as possible in determining the cost of capital. Because the valuation that you would arrive using the discounted cash flow method primarily will use these two input. Number one, projected cash flow. Number two, the cost of capital. So if you use both these input correctly, you will truly come across a valuation which is as precise, as accurate, as dependable, as reliable as it could be. And that is the precaution that you have to take. Make sure that projections that you are making are absolutely realistic, and the cost of capital that you have taken into account is also as accurate as possible. Now, what about the market approach? About the market approach, remember, quoted price is okay, but it should be cross-checked with the discounted cash flow method. So even though the valuation standards talk in terms of the quoted price to be used, even though IndAS 113 talks of level 1 input, that is quoted price. But please remember, there are thousands of examples available in front of every one of us that these stock prices fluctuate very widely. And not only they fluctuate, but many times there are so many examples where the price at which the company was quoting, within few months or few weeks or few years, that company's price has crashed. And that is because there was a misinformation. And therefore, when you are using the quoted price for the purpose of valuation of an entity, it is my strong recommendation. Always cross check the quoted price by following the discounted cash flow method so as to ensure that you arrive at a value which is as precise, as accurate, as reliable, as dependable as it could be. And as regards the cost or the asset method, please remember these are good mostly in case of liquidation. These are good only mostly in case of liquidation. And why so? Because they give you the downside. So liquidation method or the adjusted book value method will give you an idea as to, as a seller of a company, what is the minimum that you must expect when you are selling your company. So the cost and the asset approach will help you in letting you know as a seller what is the minimum that you must expect, or as a buyer what is the maximum, what is the price that you should be willingly prepared to pay, and that is your liquidation value method. Now, friends, we will now shift our gear and focus on the discounted cash flow method. And discounted cash flow method, and under the discounted cash flow method, how the valuation is done. So there are a couple of other questions that we need to answer. The first question is, what is the intrinsic value? A lot of people have a doubt as to intrinsic value is the most unreliable, undependable, uncertain, ambiguous value, which is completely wrong. The truth is, intrinsic value, if you are able to calculate, it is the most dependable, most reliable, most accurate value. And what is intrinsic value? As the name suggests, intrinsic value is the inherent value of an asset. And how do you find out the intrinsic value? You find out intrinsic value of an asset by using the discounted cash flow method. How do we use discounted cash flow method? We will understand. We will understand. But before that, let us understand what is the intrinsic value. So intrinsic value simply means it is the present value. It is the total of all the future cash flows present value. So what is intrinsic value? Intrinsic value कैसे मालूम करते हैं? Intrinsic value का मतलब है the total of present value of all the future cash flows put together is the intrinsic value. And I'm sure you can very easily understand. Now that you can calculate the future cash flows, now that you can find out the present value of future cash flows, Now that you can add them together, and therefore the total of all the just one second. Hello. So the total of all the present values of for all the future cash flows is your intrinsic value. So let me repeat it once again. What is intrinsic value? Intrinsic value is total of present value of all the future cash flows is your intrinsic value. And this you can calculate precisely. And that is the beauty of intrinsic value. Now, what is the significance of intrinsic value? The significance of intrinsic value is that it is the most accurate, reliable, dependable value. That is your intrinsic value. How to find out the intrinsic value? तो intrinsic value कैसे मालूम करते हैं? So friends, as I mentioned, intrinsic value is found out by using the discounted cash flow method. And what is the discounted cash flow method? Discounted cash flow method is you find out the projected cash flow, discounted it by the cost of capital. And when you discount it by the cost of capital, you get the present value of future cash flows. Here, we have to remember two things. There are two very important things that we need to understand when we talk in terms of the discounted cash flow method. And what those two things are? Those two things are, number one, for finding out intrinsic value or the real value of an asset by using the discounted cash flow method, we have to use two-stage discounting model. And why do we have to use two-stage discounting model? And that is because the companies that we are trying to value, those companies have a life which is infinity. So if अगर एक company की life infinite है, so how do you project the future cash flows for the infinity? Can you do it? Of course not. And since you cannot project the cash flow for the infinity, obviously you cannot find out the present value of the projected cash flow, which is for the infinity. So how do you find the solution? So you find the solution by breaking the period into two stages. First stage is known as explicit forecast period, which is also known as high growth period, or super growth period. And then you got a second phase, and that is known as terminal period, or which is also known as continuing period. So what you do in case of discounted cash flow method, break the life of a company into two parts: explicit forecast period and the terminal period. So let us now look at the 9 steps for finding out intrinsic value of shares. So the first step that you follow for the purpose of finding out intrinsic value of a company or the share of a company, uh, as I said, divide life of the entity between two component, two phases. Phase number one is the explicit forecast period, and phase number two is the terminal period. For the benefit of every one of you, let me tell you once again, explicit forecast period would mean the period of high growth or super growth, or of extraordinary growth. And where this explicit period stops, from there the terminal period starts. So let's say, for example, a company is going to grow for first 5 years at the rate of 20%. And after 5 years, or at the end of the fifth year, or from the sixth year onwards, the company's growth will become normal, and it would grow, let's say, at the rate of 5%. So this period of first 5 years where the company is going to grow at the rate of 20%, is known as explicit forecast period, and the period from where the 5 year ends. From then on, the terminal period would start where the growth would happen at the rate of 5%. So having done that, the next step that you follow is estimate growth rate in earning. So आपको ये मालूम करना पड़ेगा कि एक्सप्लिसिट फॉर, अभी मैंने एग्जांपल आपको दिया तो मैंने कहा कि 20% एक्सप्लिसिट फोरकास्ट पीरियड में ग्रोथ होगी और नॉर्मल ग्रोथ 5% की होगी. But this is what you need to find out. So when you have to do a valuation, when you get an assignment to work on valuation, what you need to do is, in consultation with the management of the entity or with your research and understanding the economy, understanding the industry, you will need to find out as to at what rate this industry is going to grow, this company is going to grow in next 5 years or 7 years, as the case may be. That is what you will need to do. So you will need to find out the growth rate during the explicit forecast period and also during the terminal period. Then you come to the step number 3. And the step number 3 is, now what you do, estimate projected cash flow of the company for the explicit forecast period and also for the terminal period. Now, really speaking, let's say, for example, the valuation that you're trying to work on, the company that you're trying to value has got a explicit forecast period of 5 years. So you will need to project the cash flow for the first 5 years. And for the sixth year, what you will need to do, you will need to take the cash flow of the fifth year, multiply that by the growth rate of the terminal period, and then divide this figure by the cost of capital minus the growth rate. And this will give you the cash flow for the terminal period, for the entire terminal period. And that is what you will need to do as a third step. So prepare the projected cash flow for the explicit forecast period, and that will also give you the projected cash flow for the terminal period. Now, remember, when you do the projections, when you are preparing, when you are making the projected cash flow, the projected cash flow can be free cash flow for the firm, or it can be free cash flow for the equity. What is the difference between the two? Very simple. Free cash flow for the firm would mean of cash flow which is available to all the stakeholders, not only the equity shareholders, but also the preference shareholders and also the lenders, all of them put together. And the free cash flow for equity, what would it mean? It would mean the cash flow which is available only for the benefit of the equity holders, only the equity holders. And that is what you will need to do as the third step. At the fourth step, you will need to determine the cost of capital. Now, friends, remember, the cost of capital is a very important number. When you want to find out the equity value or the real value or the intrinsic value of share of a company, cost of capital plays a very important role. Now that we are talking in terms of a value of equity share, we will focus only on free cash flow for equity. So, what is cost of capital? Now, this is what, friends, you have to be very, very clear. And why do we use cost of capital? So, remember, what is cost of capital? Cost of capital is nothing but return expectation of shareholders of a company. That is cost of capital. That is cost of capital. That is what that means. It is also known as minimum required rate of return. It is also known as expected rate of return. It is also known as benchmark rate. It is also known as hurdle rate. So there are many names to the cost of capital. What we need to understand, why do we have to use cost of capital for discounting the future cash flows? Please understand it. It is very simple. As a businessman, when I am investing my money into any other business, whether organic growth or inorganic growth, what is the minimum that I would expect that business to give to me in return is my cost of capital. Meaning what? Meaning the business that I am starting, I am putting my capital into that business. That capital which I am putting has got a cost. So this business has to give me at least which is equal to the cost of my capital. And that is the reason why we use the cost of capital for the purpose of discounting the future cash flow. Please remember, cost of capital will include what? And that is again something that you must be very clear about it. So cost of capital would include what? So it would include number one, the inflation, right? So obviously, uh, as a businessman, when I am investing my money anywhere, least that I would expect is that I get a return which is equal to the rate of inflation. And why rate of inflation? Because if the rate of inflation is 7% and the interest that I am getting or return that I am getting is 6%, my money is already eroding. So number one component is the inflation. Number two, remember when I'm starting business, I am taking some risk. So obviously, I have to add some premium for the risk that I am taking. So let's say the inflation rate is 7% and the risk that I am taking is, let's say, 4%. So therefore, 7 plus 4 becomes 11%. Now, depending on the nature of the business, I may also like to add something on account of the extra risk that I'm taking in running that business or investing in that business. Let's say that is 3%. So 7 plus 4 plus 3, and that is 14%. So my cost of capital is 14%. Now, any business I invest my money, it has to give me a return minimum of 14%. Only then I would invest. So that is the significance of cost of capital, and that is the utility also of the cost of capital. So now what you have done, so you come to the fourth stage. Now that you have projected your cash flows, you have also arrived at your cost of capital. Now do the discounting of the future cash flows using your cost of capital. So when you do the discounting of the future cash flows using your cost of capital, you will arrive at the present value of the explicit forecast period, and you will also arrive at the present value of the cash flow of the terminal period. You add them together. So present value of cash flows during the explicit forecast period plus present value of the cash flows during the terminal period put together is the intrinsic value of that business, is the intrinsic value of that company. And now when you so you now that you have arrived at the intrinsic value of that company or of that entity, now what you have to do, you have to make certain adjustment in that value. So what adjustment will you make? तो आपने क्या किया? आपने following the six steps that I have just spoken with you, you have arrived at the intrinsic value of that entity. Now you have to make certain adjustments. What adjustments? Let's say, for example, you have arrived at the intrinsic value of a company which is 1,000 crore. Now, this company also has a piece of land lying somewhere which is worth 100 crore. Now, tell me, would you need to add that 100 crore into this 1,000 crore or not? And the answer is yes. Why the answer is yes? The answer is yes because 1,000 crore is the value using the discounted cash flow method, that means based on the cash flow of the company. तो ये 1,000 करोड़ तो मैं कमाऊंगा ही कमाऊंगा, उसके अलावा जो 100 करोड़ की जो लैंड है वो भी मेरे को साथ में मिलेगी. तो इसका मतलब इस बिजनेस की वैल्यू कितनी हो गई? 1,000 प्लस 100, दैट इज 1,100 करोड़. So that is what at those adjustment that you will make in arriving at that value. So now what you do? Now you will divide the total of intrinsic value by the number of shares this company is having, and that will give you the equity value per share, or that will give you intrinsic value of share of that company. So friends, this is how you will use the 9 steps for arriving at the intrinsic value of a share, or the real value of a share, uh, or the discounted cash flow value of a share. As I said earlier, discounted cash flow method is the most dependable, reliable, accurate method for the purpose of arriving at the fair value of any business. A question that may be coming to your mind is, when can discounted cash flow method be used for the purpose of valuation? Now, friends, let me tell you, uh, primarily, if you look at the valuation, so uh, there are three classes of assets that need to be valued. Number one is the land and building. Number two is the plant and machinery. And number three is the securities or the financial assets. Where can the discounted cash flow method be used? I will say any asset which has capability to generate cash flow, the discounted cash flow method can be used. So the discounted cash flow method in the context of securities or the financial assets can be used for doing the valuation of business and equity, as we have just seen. It can be used for the purpose of valuation of intangible assets. It can be used for the purpose of valuation of fixed income securities. It can also be used for the purpose of valuation of derivatives. It can also be used for the purpose of valuation of other financial assets and liabilities. So, friends, this is all that I had to share with you on how to find the uh, intrinsic value or the real value of any asset using the discounted cash flow method. In case if you have any question, you can, Nishal will read it out. You can type your questions in the chat box. Nishal will read it out, and I would be very happy to answer all your questions one by one. Thank you. सो निश्चल आप चालू कर सकते हैं, और जो भी क्वेश्चन अगर कुछ आ चुके हैं ऑलरेडी तो उनको ले लेंगे एक एक करके. All right, so while you are typing your questions in the chat box, let
Uh,
me
so, uh, okay. So
yeah.
the first question is, sir, can NAV of MF be called quoted price?
Can you repeat the question, Nishal?
Yes, sir.
Hmm.
Can NAV of MF be called quoted price?
Can NAB be called as the quoted price? Actually, NAB will not be the quoted price. Quoted price would strictly mean the price which is quoted on a stock exchange. So NAV will be a book value of the security and not the quoted price. Quoted price का मतलब है a price which is available, a price at which a particular security is trading on a stock exchange. I hope that answers his questions, Nishal.
Okay. So the next question is, how do a minority shareholder get projected cash flow of a company to do DCF valuation?
So the question is, how a minority shareholder do the projected cash flow for the purpose of valuation of his share. Uh, to put it very simply, whether minority or majority, when you are doing the evaluation of an entity, you keep that aside for the time being. First, do the evaluation of the entity using the discounted cash flow. And once you have arrived at the intrinsic value of the business using the discounted cash flow, then depending on what is the share of the minority interest, and what is the share of the majority interest, the value of them respectively would be decided accordingly. There can be a question of some adjustment that may arise depending on who is buying or who is selling, and again, whose need it is. So if the minority interest is in the need to dispose of their holding, the majority would be able to negotiate a price which is favorable to them. Or when the majority is in need of acquiring the minority stake, in that case minority will be able to negotiate a better price for them.
Okay, sir. So the next question is, how to select beta when there are no comparable listed companies?
Very good. So the question is how to calculate beta of for a company when that company is not listed. So one thing is very clear, that beta will be available for any company only when it is listed. So if you need to find out the beta of a company which is not listed, again you will have to use the comparable company method, which means you will need to find out if the company that you are trying to value, which is not listed on any stock exchange, you will need to find out a comparable company in terms of industry, in terms of product, in terms of size, and in terms of so many things, which is available on the stock exchange. So you can use the beta of the entity which is listed on a stock exchange as the starting point, and then depending on what is the debt component in that company, in your company, you and some of the other things, you will make suitable adjustment to find out the beta of an unlisted company. Now, so that is one. Another method of finding out the beta is list out all the risk factors that you would see in the company that you are uh, trying to compare. List out all the factors, and then you can give your own weightages in your understanding. Only thing is you should be able to justify it. You should be able to substantiate it as to why are you giving those weightages to them. And based on that, you will be able to arrive at your own beta also for a company which is not listed.
So the next question is, how do you fix company specific risk premium?
Very good question. So how do you fix a specific risk premium for a company? Friends, remember, that is where we will have to use as valuation professional our experience, our expertise, our exposure, and our judgment in deciding as to what can be the specific risk premium. So obviously, firstly, you will need to identify as to what are the risks which are applicable to this entity, which are extraordinary. And in that case, there is no set rule for deciding as to what can be the specific risk premium. It will need to be based on the judgment of the valuation professional, and only thing that he has to remember, that whatever figure that he arrives at, he should be able to substantiate. Please remember, substantiate when, not in future, substantiate today. So when as a valuation professional, you are picking any figure for the specific risk premium, find out as to what those specific risks that you are talking about. Use your experience, your judgment, your expertise, and document it, that for this valuation, for the valuation of this entity, in my understanding, following are the specific risks applicable to this entity. Based on my understanding, judgment, experience, and expertise, and taking the following factors into account, I think a risk premium of 3%, 2%, 4%, 5%, as the case may be, can we or should we add it to the cost of capital. So this is how you can arrive at the specific risk premium depending on the situation that you are in. Yes, Nishal?
Yes, sir. Next question is, how can we evaluate the equity share of an unlisted company for the purpose of transferring 5% share from existing shareholder to a new shareholder? Which is the most suitable method in this case?
Remember, okay, the question is how to do the valuation of a private limited company for transfer of 5% shares from the promoters of the company. Now, the remember, so it is an unlisted company. Since it is an unlisted company, label one input is out because it's not quoted. Uh, Label 2 input is also not available because being a private limited company, it is unlikely that you will be able to find out a comparable company. So what choice are you left with? You are left with of the choice of input label 2, input 3 label, or label 3 input, which is what? Which is use of unobserving unobservable information. That means what? As I mentioned in my session, that means you will need to use the discounted cash flow method only. And let me tell you, as I have said earlier, discounted cash flow method is the most accurate, most dependable, most reliable, most used method world over for the purpose of valuation. तो आप क्या करिए, आप डिस्काउंटेड कैश फ्लो मेथड यूज करिए। और जैसा मैंने पहले कहा, याद रखिए कि जब आप प्रोजेक्शंस कर रहे हैं, मेक श्योर दैट योर प्रोजेक्शंस आर रियलिस्टिक. When you are taking a cost of capital, make sure that your cost of capital is also realistic. And by using the discounted cash flow, and remember, it doesn't really matter 5%, 10%, or 20%. Ultimately, what you do the evaluation of the business. So first you do the evaluation of the business, and then depending on the value of that business which is arrived at, you divided it by the number of shares that the company is having. So you get the value per share. And then, of course, that becomes your reference point. And the buyer and the seller can take that reference point as the starting point for the purpose of decision making.
So the next question is, HOD intrinsic value is applied practically in the purchase of equity shares. Is it okay by DCF explained by you?
Can you repeat the question once again? The first part was not clear.
Okay. HOD intrinsic value is applied
What,
practically in the
what,
purchase.
oh, no, no, what, HO,
HOD.
HOD?
Yes, sir.
What is HOD? I don't know.
A
Oh,
question. Okay.
okay, you can go to the next one.
Okay. The next question is intrinsic value of unquoted share where the company is not generating revenue but with an immovable property. In such case, which method of valuation to be used? Replacement method or liquidation method?
So very good. The question is, remember, first of all, the discounted cash flow method is applicable or can be used only in case of a going concern. So only when a business is going to generate cash in future, only then you can use the discounted cash flow method. If a business is closing down, you cannot use the discounted cash flow method because that business is closing down. It does not have the potential of generating cash flow in future. Therefore, the discounted cash flow method is ruled out in case of a business which is not a going concern. Now, how do you do the evaluation in a case like this? As I have explained earlier, you have the choice of using the adjusted book value method, or you have the choice of liquidation method. That means what? That means whatever are the assets that are available with the company, uh, you list them and make adjustment to reflect their current price at which those assets can be sold. From that, you deduct the liabilities, and whatever becomes in the but whatever remains in the bottom, and that becomes the value of that entity. So that is what we have to remember, that discounted cash flow method can be used only in case of a going concern and not in case of a business which is undergoing liquidation.
Okay, sir. So that question is how intrinsic value is practically applied for purchase of equity shares. Is it by DCF model explained by you?
Right. So it was not HOD, it was how. Is that right, Nishal?
Yes, sir. Attendee
Okay.
made the correction.
Right, right. Okay. Okay. Just repeat the question once again, Nishal.
Sure, sir.
Hmm.
How intrinsic value is practically applied for purchase of equity shares? Is it by DCF model explained by you?
Yes. So the question is how equity value is found out realistically or practically using the discounted cash flow method. Remember, globally, uh, all the transactions which take place in the foundation, it is always the discounted cash flow method. So whenever you're trying to find the value of an equity share of a company, you will always use the discounted cash flow method, and then you will also support it by the market in market approach, just to doubly ensure that your valuations are on the realistic side. So this is how, and practically, yes, as I said, all the going concern transactions, virtually transactions for of acquisition or takeover or transfer of shares, whenever they happen for any business entity, it is always based on the discounted cash flow method.
Okay, sir. So question are over.
Okay, very good. So now, before we close, I just like to take 2 minutes and share with the participants and tell something about myself. So for me, vision and mission is knowledge of finance and awareness of work-life balance to everyone. uh, our beliefs are leaders think differently and do right things in right way. Grass grow by itself. Mango trees need to be planted and nurtured. So in line with our vision and mission, what we are doing, we are working on spreading knowledge of finance to everyone and also knowledge of work life balance to everyone. Accordingly, uh, we feel and we communicate to all that finance is not difficult, rather it is music to the ears. I have delivered programs on finance world over in more than 50 locations. Some of the locations where I have delivered the program is Poland, uh, Luxembourg, Ukraine, Canada, Costa Rica, Chicago, Brazil, Belgium, Paris, Russia, so on and so forth. We also share the knowledge of work-life balance with everyone globally. I am also a marathon runner, have run more than 100 marathons already. I'm also a cyclist, have cycled to various part of the world. Have authored two books. One is Finance for Value Creation, and second is You Are a Born Winner. Both these books are available on Flipkart and also on Amazon. Uh, I have a YouTube channel where uh, I have uploaded over 200 videos covering aspects like finance, accounts, Companies Act, strategic management, IndAS, insolvency, business valuation, India's economy, independent directorship, corporate governance, leadership, and work life balance. I have over 24,000 followers on my LinkedIn. So I would recommend that all of you connect with me, join my YouTube channel so that you are able to get the benefit of these 2,000 videos. And also connect with me. You're welcome to connect with me on LinkedIn. And because that's where I keep sharing a lot of valuable information from time to time on my LinkedIn page.